Alrighty, we are live. So, guys, there is a new top dog in my portfolio, and I'm going to tell you all about it in tonight's live stream. But before we get into that, welcome to another Dividend Happy Hour. I hope you guys had a fantastic week, and I'm so stoked to be back with you guys for another one of these happy hours. Always a good time. So, why don't we kick it off the best way we know how with a quick cheers? And we're not going to toast anything too spectacular tonight. Let's see, what should we toast to? Here's to another good week on the market. I don't know about you guys. I had a pretty decent week. It wasn't anything spectacular, not any crazy highs. Actually, KRC did pretty well today. But other than that, not really any crazy highs, not really any too lows or too crazy lows. So all in all, we survived another week on the market. And I think that's worth cheersing to. So here's to that. Also, here's to you guys. Thank you for tuning in with me tonight. Real quick, guys, let me know a few things here in the live chat or in the comments below if you're watching the replay. Number one, what did you buy this week? Which stocks did you add to your portfolio? I'm curious to know. Number two, what are you sipping on tonight for the Dividend Happy Hour? I want to know about that as well. But also number three, did anything cool happen in your portfolio? You guys hit any big milestones, any portfolio value milestones? I know there's been a lot of that lately just with the state of the market. So any of that, any dividend income milestones, maybe you got your biggest dividend payment ever, or, hit your first $1,000 of annual dividend income, anything like that. I want to hear about it in the chat here or in the comments below so we can, in the chat here so we can put it up on the screen and celebrate it. Tonight, guys, I'm sipping on, it's my first time trying this. My fiance bought these sparkling ice. Have you guys ever had these before? The flavor of this one, it's got to be some sort of holiday flavor. It's cranberry. Yeah, definitely. It's cranberry frost. But it's really good. I'm only, as you can see, a couple sips into it. And it's pretty delicious. And you know what, too? She actually bought some Fanta, zero. I don't know if it's 0-calorie Fanta or Fanta Zero or Fanta. I don't know how you pronounce it. But she bought a couple of those as well. And those are bomb. And you know who makes Fanta or Fanta? Got to shout out Coca-Cola on that one. But I want to go through the chat real quick, say what's up to you guys. And for those of you who are just now tuning in, it looks like there's 92 of us right now. First and foremost, welcome. But in case you're just now tuning in, tonight I'm going to be telling you guys about the new largest position in my portfolio. There's one in particular that recently surpassed my other top holdings. Those are going to be Realty Income, Procter & Gamble, Starbucks. So we're going to get into that momentarily, but let's spend a little time here getting caught up in the chat. I see, starting all the way at the top here, I see Michael, I see Galactic, Pat, we got Andy in the building. We got my man Harris here. What's up, Harris? We got Dr. Neubenstein. Good to see you, man. We got Adon, Dorte, Anthony, Thomas. What's going on? Did I already say what's up to Andy? Yeah, I did. I'll say what's up to him again. What's up, Andy? Let's see here. We got Chris, Mountain High. Good to see you. Excuse me. Fast Eddie. What's going on, Eddie? We got Coach Tim checking in. We got the coach checking in here. We got Norman, always supportive, always inspirational, always motivating. Norman, keep going, Ryan. You do the same, my friend. Thank you for all the support and inspiration. We got Joyce in the building. Oliver's here. Cheers, buddy. Cheers to you, my friend. Hope you're doing well. We got El Dynamico all the way from sunny Sacramento, California. Although I don't know. How's the weather up there? I was talking to my dad yesterday. He said the weather's been pretty good up in Northern California. We got Stoner's Gym in the building. I see a lot of you guys talking about WP Carey, maybe thinking that that's now the new top dog. I guess we'll find out. As you guys know, a lot of you guys know WP Carey officially reduced their dividend or announced that they'd be reducing it for the upcoming payments, which is really no surprise. Like this is not new news, but the specifics surrounding exactly how much they were going to be reducing the dividend by were a mystery up until yesterday. But from what I've seen, it was about a 20% reduction, which stings, but once again, not entirely surprising. Everything I read and listened to kind of leading up to this suggested that it would be somewhere in that range, somewhere between maybe like 15 to 20%. But anyway, it is what it is. We got Australia's in the building, and Australia picked up some VU, Procter & Gamble, and then Piedmont Lithium. Okay. We got Haas here with some Brookfield and SCHD. Thomas bought some Medtronic ADT, VGT, and SCHG. Very nice. Very, very nice. Let's see here. We got Pat picked up some Enbridge. El Dynamico finally got me some SCHD. Nice, man. That's great. I'm surprised this is your first time buying into the fund, but good for you, man. Welcome to the party. Welcome to the SCHD club. Let's see. Adon sipping some water, dripped Discover, and Johnson & Johnson, and bought some more SCHG. Good stuff. And we got Coach Tim here with a pretty big milestone, guys. Paid off my mortgage at the age of 44, now living completely debt-free. Jeez, man. That's unreal. Congratulations. That seriously is such a huge accomplishment. But Tim, I'd be curious to know if you'd be willing to share. I'd be curious to know how long it took you to pay off your mortgage. Very inspiring, man. Good job once again. We got Anthony here with another milestone, getting my biggest dividend payment so far on Monday, $2.35 from SCHG. That's incredible, man. Great job. You're off to a great start there. Oh, this is nice. This is really cool, actually. I've been dollar cost averaging from Chris here, $10 a day into VU for over a month. And yesterday, I just got my first share. Good job. Let's see here. Jeremiah, greetings from Kentucky, sipping on Ale 81, a Kentucky ginger ale. I love ginger ale. That's good stuff. Let's see. Let's go. Keep going here. Joey's picked up some Aries Capital, SHD, JXN. Why is that one? I know the ticker, but I can't place that with the company or the fund at the moment off the top of my head. JEPQ and a few more. Drinking some Calypso lemonade. Calypso's great. Good stuff. We got Dorte here sipping on a Rockstar that I got for free. No sucker guava taste. There you go. Let's see. Let's keep going. Mountain High. Did you pick up some Rollins? Is that what you're saying here? You bought into Rollins. Good job, man. Man, that's great. At a whopping like 41 or something dollars per share, but good job, man. I think that's what you're saying, right? That's what you bought this week. Let's see. We got Justin here, NSA, HASI. I'm not familiar with that one. And then some AbbVie. Let's see. Keep going. Oh, wow. Billy's, I'm here from the Philippines. Good job. Sir Dude Bro Man in the building. Good to see you, my friend. We got Ice, baby. Do you like Realty Income? Oh, I love me some Realty Income. I sure do. Realty Income is now my fourth biggest holding, I think. We'll take a look at it. We'll look at it in just a couple of minutes. Let's keep going, though. A couple more of these guys that we'll get into the main event. And truth be told, when we go through this, I won't spend too much time going through the whole spiel. I did want to update you guys on this little change in positions, though. But anyway, let's keep going here. Mauricio picked up some Hershey's, or the Hershey Company, HSY. That's a good pickup. The Hershey Company's been really coming down in share price. So I think if you're going to buy some, now's not too bad of a time. Not too bad a time to do it. Excuse me, guys. Clayton here says Procter & Gamble, J&J, and VTI. You can't go wrong with any of those, really. Ooh, there we go. Morik, a Virgin Cuba Libre. I bought one. I think you're saying $1,000 of Realty Income, and $500 or so of Coca-Cola, and then my weekly investment money was gone. Nice. Let's see. Let's keep going here. Sir Dude Bro Man, some really nice pickups here too. So Visa, Altria Group, and Sherwin-Williams, which is one that doesn't really get talked about enough. But from what I remember, it's been a while since I looked into that company, but the financials of Sherwin-Williams were looking pretty good. And I think from what I remember, I could be wrong on this, but I thought they had a pretty nice dividend growth rate as well. Let's see. Yeah, Morik, this is good. I stopped drinking for getting fit. That's a good move, and it really does make a big difference, especially as it pertains. Especially if you're trying to lose weight and burn some fat. Not only just for the sake of the calories that are in the margaritas that I love so much, but alcohol in itself. Your body when you consume alcohol, it switches gears, and instead of burning fat and carbs and stuff for energy, it prioritizes that alcohol. So it kind of really cuts into the fat burning process and kind of eliminates it temporarily until it works through all the alcohol. So it definitely makes a big difference in losing weight, leaning out, stuff like that. Let's keep going here. So Jay, this is a pretty good guess. It's Williams-Sonoma. Thinking Williams-Sonoma might be my one of my or might be my top position. That's a good guess. With the way that Williams Sonoma's run up, honestly, wouldn't surprise me if that ended up being the case. Let's keep going here. A couple more of these guys, and we'll get into it. Okay, so Jay here, really nice buys here. So Kroger, Starbucks, which man, Starbucks is really kind of not aggressively, but it's slowly kind of making its way back down in share price. Then we have Whirlpool, very nice. Let's keep going. X-Date, Johnson Financial, blah, blah, blah. This is a good question. Is there any point in buying SCHD now or wait for it to drop? SCHD is one of those you can just dollar cost average into, in my opinion. Just buy it every week. Don't even think about it. Oh, okay. Gotcha. Oh, Rollins was a comment when you mentioned what you picked up in the new position. I picked up Corning. Is that what GLW is, right? No, I did unfortunately have not bought any Rollins. No Rollins. And this isn't a new position either. Like, this is a position currently in my portfolio, and it's become my top dog. I have not started any new positions yet, but we'll see what happens. Oh, yeah, there we go, Joyce. Jackson Financial, it's up 29%. Okay. I don't believe I've looked into that one, but the name's familiar for sure. Oh, there we go. This is cool. My first time here, just watched you last night for the first time. That's great. Well, thank you so much for tuning in. And in case this is your first time tuning into the Dividend Happy Hour, we are, believe it or not, guys, at episode 76, which means we've been doing this happy hour now for, 76 weeks, almost consecutively. I mean, we missed a few here and there, but man, can you believe it? It's really flown. I think I started doing this September, maybe July or August or September of last year. I don't quite remember, but yeah. So what I was saying was, in case this is your first time tuning into the Dividend Happy Hour, we do this every single week. Okay, Friday nights, 5 p.m. Pacific time. We are here, libation in hand, and we're going to talk some stocks for an hour. So, oh, what do you mean DCA? DCA stands for dollar cost averaging, and dollar cost averaging is essentially when you invest a set amount of money for on a regular period. So, investing $50, that's just a random number, by the way. It could be 5, it could be 10, whatever amount you want. Investing a set amount over a set time period on a consistent basis. That was a really bad way of explaining it, but $5 per week, every single week, or $100 per month, every single month, consistently without pause. That's dollar cost averaging. Really bad way to explain it. Okay, let me just get caught up in the chat right here. I'm really scrolling quick, so I apologize if I skip some of your guys' comments. We can circle back and take a look at them after the spiel. So, okay, so there is 181 of us in the stream right now, and in case you're just kind of now tuning in, I have a new top dog in the portfolio, a new highest position. And prior to this, it kind of went back and forth depending on the day, but my two largest positions, my number 1 and number 2, were Procter & Gamble and Starbucks. I love both of those companies. This third one, though, I'm a pretty big fan of this third one, which is now in the number 1 spot. So I want you guys to guess in the live chat real quick. What company, what stock do you think this is that is now the largest position in my portfolio? Do you guys have any guesses? I'm curious. I know a lot of you guys are going to guess this one. Mountain High says Williams Sonoma. That's a good guess. That's a really good guess. Jordan says Johnson & Johnson. Harris, Johnson & Johnson. Pat, Snap-on. Jay says Altria. Yeah, I see some more. Williams Sonoma. SCHD, that's a good guess. Realty Income's a good guess as well. Someone had to say it. Someone had to say Rick. Someone had to say RCI Hospitality. Good job. Good job, coach. Shan here says Realty Income or Coca-Cola. Good guesses. Okay, the Dividend Pro says Lowe's or J&J. Journeyman, J&J. Williams Sonoma. Yeah. Snap-on. Really, really good guesses. Yeah. I don't even know what this is. I think it's one of the this is one of the yield max funds, isn't it? Yeah, really good guesses, guys. Oh, there you go. Wes hit the nail right on the head here. Okay, guys. Well, this stock is Johnson and Johnson. And the interesting about this, I'll show you the position in a moment. I'll show you just where it sits in the portfolio right now. But Johnson and Johnson is now the top dog in my portfolio. And the thing about it is, I've this kind of snuck up on me for a long time. My top five really hasn't changed around too much, but just with the way the market's kind of moved, it has resulted in a bit of a fluctuation in the top five. So historically, it's been, like I said, interchangeably Starbucks and Procter and Gamble in the number one and number two spot. Number three was like always Johnson and Johnson. Number 4, 5, and 6 kind of danced around between Realty Income, Lowe's, Williams Sonoma. And I think that's kind of it. But as it stands now, Johnson and Johnson's the top dog, guys. And the crazy thing about it, this is what I was trying to get to, is I really haven't. I don't personally feel that I've really been buying Johnson and Johnson super aggressively. Now I have as of late, these last 2 or 3 weeks. I think I've bought it. And you guys remember. You guys probably might remember better than I do, actually. These last few weeks, I've bought it back to back to back. I bought like a share this week. I bought almost a whole share last week. And then the week prior to that, I think I bought close to 1 share as well. But in total, in 2023, guys, if we take a look at this, like I said, this is not across an entire year. This is not a huge amount of contributing to the position. About $1,500. And in total this year, I guess it kind of is. I picked up about 10 shares. And after that, this is where, let me do this now. Switch the screen. This is where Johnson & Johnson stands in my portfolio right now. So here's the position, right? Yeah, you guys can see that. It's let me zoom in a little bit more. So it's just a bit larger. Hopefully that's not, no, that's good. That looks good. So right now, guys, Johnson & Johnson is 8.2% of the overall portfolio. And I'm pretty comfortable with this. I feel fine with this. Kind of my rule of thumb, both in terms of the weighting of the position and the amount of dividend income it's generating. This applies to any one position in this portfolio. I'd prefer, with the number of holdings I have, I'd prefer to not let it get above 10% in either department in terms of weighting, the dollars allocated to the position, or in terms of dividend income. So Johnson & Johnson still below that threshold, 8.2%. And then right now we've got Procter & Gamble in second place at 7.6%. So there's a bit of a spread between these two, 8.2, 7.6. We're looking at about, definitely over, 0.5% difference in weighting. Starbucks is in third place. And it looks like, guys, fourth place might be Williams Sonoma at 7.08%. No, it's actually fifth place. So Johnson & Johnson, Procter & Gamble, Starbucks, Realty Income, Williams Sonoma, and this is only because, as you guys know, Williams Sonoma has just run up so much. So Williams Sonoma in fifth place, and we got Lowe's over here in sixth, 6.88%. Then we got KRC coming in seventh place at 6%. And KRC's actually had a pretty good month as well. I think there was one day this week, guys, they were up about 5.25%. So they had one really good day, and I'm officially back in the green on my position. But let me see. Let me go over here, look at my notes. So this is where it sits just in terms of weighting. Looking at income, it's also becoming one of, I guess not so much actually. I thought it was going to be like one of these. So in terms of income, Johnson & Johnson's only generating 5.3%. So there's still a lot of room to grow this before it's at that 10% mark. And fortunately, I don't have any one position that's really there. I mean, these three are kind of up there. Realty Income's the top dog. Altria's in second. Blue Owl's in third. EPD, which I would not mind boosting that some. And then we've got WP Carey in fifth. Anyway, not important. So anyway, 5.3% in terms of income. Okay, 8.2% in terms of weighting. Now, looking at my overall J&J position, it is going to be right here. And by the way, guys, we are looking at my dividend portfolio tracking spreadsheet. And if you want to download this, it's free to download. There's a link in the description of the video. But right now, with all these purchases, like we saw just in 2023, I picked up about 10 shares of J&J. So at this time, I have 26.25 shares. So what is that? I don't know what percentage of that is, but nearly half of my J&J position has been purchased just in 2023. And this is one of the first dividend stocks I bought. When I first got into investing, Johnson & Johnson was one of the first additions to the portfolio. J&J, Coca-Cola was in there. I think Chevron was in there as well. We had probably Altria Group, Realty Income, Procter & Gamble, Starbucks. Southern Company, believe it or not, was one of those as well. But anyway, so 26 and a quarter shares at an average cost that's a bit above the current share price, about $162. And this has come down. I've been buying it, like I said, pretty much all throughout the year, maybe a little bit heavier just these last few months. So the average cost per share has come down a little bit, but I'm still seeing a little bit of a loss with JNJ right now, which is why at least over these last few weeks, I've been adding more to the position. So I'm still down about 4.6% in terms of share price. On a total return basis, I'm now officially in the red as well. This wasn't the case yesterday, but today it looks like it brought it down a little bit more. That's okay, guys. This is one of those I feel totally fine. I mean, Johnson & Johnson's the king of dividend kings. It's one of them. It's definitely one of the more premier dividend kings. So I do not mind having a large position in this bad boy. And looking at some of the dividend stats too, they're actually not too shabby. I mean, they're sitting at about a 3% yield. My yield on cost, because I'm down, is a little bit lower. The 5-year growth rate is pretty moderate as well, about just under 6%. So you get about a 3% yield, about a 6% 5-year dividend growth rate. I would call that like the Goldilocks dividend stats. The yield's not too high, it's not too low, it's pretty respectable. The 5-year growth rate's kind of the same. Not that there is such thing as a too high of a dividend growth rate. I mean, the more the merrier for sure. But it's moderate. It's not too low. It's enough to get excited about, and so far has proven to be pretty sustainable because they have, I think, 60 to 62 years of dividend growth. I don't remember off the top of my head, but anyway, that's where we're at, guys. Johnson & Johnson, the new highest position in the portfolio, and I'm not mad about it. And here's my plan with J&J moving forward. Let me just go back over here. So while I'm down 4 point something percent, I'll likely continue to buy J&J. Exactly how much, I don't really have a plan for it, but I'll probably just keep buying until I'm no longer taking a loss on it. I mean, let's go back over here. Actually, I'm looking at some of the other positions I have that I'm down on right now. I mean, Jeppy, that one's kind of on the chopping block for me. J&J, fine. Altria, I'm down a little bit on, but I don't really want to add to this right now. Realty Income, this is probably one of my most purchased stocks this year is Realty Income, if not the most purchased stock this year. And I'm kind of good on that one right now. I feel like I'd rather add more J&J, AT&T, and Verizon. I don't plan on adding any more of those. WP Carey, I am down a little bit on, down 5%, nothing too crazy. Still up on a total return basis, which is nice. So I wouldn't mind adding any more. I would not mind adding some more to this as well. So really in my portfolio, I'm looking around at my two holdings. I'm going to zoom out a little bit because I want to show you guys something here. So I'm looking around, my portfolio, and the only positions that I have that jump out to me that I think I'd like to add to at this point are going to be Johnson & Johnson and WP Carey, which is, I'm glad that I have those two. And I guess I could, if I really wanted, I could add to any single one, but I'm just trying to think in terms of which ones are around my average cost per share or which ones can I average down on that I'd like to increase my position in. But outside of that, guys, it's, that's kind of it for me right now. And it's kind of an interesting time to only have two options, I feel, because with the recent sale of Intel, I have about $3,000 in cash still sitting on the sidelines. And at some point I will deploy this in full back into the portfolio. And, in the meantime, I'm also planning on getting out of a couple more positions. I've talked about selling Jeppy. I'll probably do that sometime soon, possibly before the end of the year. We'll see. AT&T and Verizon, I will end up selling as well, but I don't know how much of a rush I'm in to sell these. I mean, I feel that I could continue to recoup some losses if I just hold on to them. I mean, I'm actually really not doing too bad with AT&T on a total return basis. This is not too shabby. Verizon's a bit of a different story, but anyway, we'll figure that out. So if I decide to sell Jeppy, I'll be even more flush with cash than I already am. I'll have about $4,100 to reinvest back into the portfolio. In which case, I could add some more to Johnson & Johnson. I could add some more to some other positions in my portfolio. I likely will do that. Or I could start a new position or potentially two new positions. As you guys know, there's a few stocks on my watch list right now that I would not mind having in the portfolio. Rollins is one of them for sure. I've been talking about that one to death. And I actually want to show you guys. Let's go over to Seeking Alpha. I'll show you my watch list too, just so you can see which stocks are on them. So it's pretty basic too. I don't have too many stocks on the watch list, and I just added Mastercard on here just to kind of I kind of want to compare and contrast with Visa, but really I had my eye on Visa. And yesterday, guys, I spent literally all day yesterday looking into Visa. I learned and took notes on the full history of the company from its origins to today, and I meant to spend some time going through just some of the financials and getting into more nitty gritty details today, but I ran out of time. So next week I'll try and do that. But Visa is one I really have my eye on. I'd love to add this to the portfolio. Vici Properties is one. I said this before, but I always keep Vici in the back of my mind, and it might just have to find its way into the portfolio. I don't know. But then Rollins as well. This is one that I've talked about for a while. I was actually watching one of them. It's kind of funny. And then Mastercard. But once again, comparing and contrasting to Visa, I don't want to own both of them. I want to just own one of them. So I need to figure out which one it's going to be. But I do feel that it will be one of them. What was I going to say though? Oh, I was watching one of my old videos from last year, like almost exactly a year ago. And in the clip, whatever I was watching, it showed my watch list, and Rollins was still on there. And truth be told, it wasn't. I mean, I guess we could look. The share price around then, I don't remember what it was off the top of my head, but a year ago, guys, the share price was. I mean, it's $41.43 right now. On December 8th of last year, it was $39.24, which really hardly budged in the last year. But anyway, that's pretty much all I got for you guys. Johnson & Johnson, top dog. I'll continue to add to it. May add some other positions to the portfolio. If I do, you guys will be the first to know. Similarly, you'll be the first to know if I sell out of anything else like JetB or AT&T and Verizon, if and when that does happen. Not if, it will happen at some point. But I want to put it back on you guys. I want to hear from you. What is the largest position in your portfolio right now? Let me know that in the live chat or in the comments below if you're watching the replay. I'm curious to know. So I'm going to see what I missed here in the chat as you guys are answering too. We'll go through some of these, go through some of your comments too. This is a good question too, kind of on the subject. El Dynamico says, having a new top position, did you do that on purpose or was that an accident? Yeah, honestly, it was just something that kind of happened. I didn't really plan on it. I guess you could say it was an accident. Outside of not wanting to get too overweight in any one position, I don't keep too many tabs on the diversification. I do one of my holdups with Vici Properties is not wanting to add, have like 4 different real estate investment trusts in my portfolio. But I don't know, that might be something I just need to get over. But otherwise, I don't really pay too much attention to how many, how each sector is weighted. Not at this point. Maybe down the road, that's something I'll pay more attention to, but not necessarily right now. While I'm still trying to find my groove, still trying to get a feel for the companies that I actually want to have. And I'm going to talk more about this in my video on Sunday. I'm going to talk more about this in another video coming out later this month. But one of my themes for 2024 and beyond is going to be to simplify things a bit more. I don't want to end up, I talked about just now selling out of a few positions. What I really don't want to do is, I guess, remove some just to add the same amount. But I guess what I'm trying to say is, I want to make sure the positions that I own moving forward are ones that I definitely want to. I'm kind of tripping over my words here, are ones that I want to, I don't want to say hold forever because you really never know, but are ones that I'm kind of losing my point here. What am I trying to say? I don't know. Let me think about it a little bit more. I'm tripping over my words. This is going to bother me now. I guess what I'm trying to say is moving forward, I want to spend more time researching the companies that I potentially want to add to my portfolio. And in doing so, the ones that I will choose to own will be ones that I will, because I've spent more time with them and I ideally will understand them potentially better than some of the picks that I've made in the past. based on not doing as in-depth of research. These new positions will be ones that I will hold to never, potentially never let go of if I can stand it, or if I can help it, unless something crazy happens. Obviously, never say never. I used to, and I just kind of now said it. Buying stocks with the intent to hold them forever, but I instead think a better way to word that is buying stocks with the intent to hold for the long term. So let's keep going here. And sorry, guys, I know that was a mission for me to get through. I was really just thinking out loud, though. So that was something. Yeah, that's why it came out so wonky. Let's see. Let's keep going. So I see Mike here, largest position as SCHD. Anthony says SCHD, 33% of the portfolio. Adon, we got SCHD. Trevon, BLK, there you go. Wallet Invest, 327 shares of VTI. That's very impressive. We got Joe here with Berkshire, Kevin, VTI, Chris here, Kama, Google for non-dividend payer, nice, and then SCHD for the dividend payer. Very good. We got Pat here with SCHD and Enbridge, SCHD, a lot of SCHDs. Wow. Let's see, Galactic, JNJ, 16%, SPY, and 15%. Nice. Let's see, we got Sir Dude Bro Man with some Broadcom. Largest in terms of share count is Realty Income. Okay, there you go. Kama says you should sell Verizon, AT&T, and JEPI and open positions in Visa and Vici Properties. That's kind of what I'm thinking, actually. That is kind of what I'm thinking. And then over time, potentially, like let's say I want to do some consolidating down the road, which could definitely be likely. I could, having 4 REITs, real estate investment trusts, I could certainly easily, I could narrow that down to 2. So, but yeah, in time, I think over these next couple of years or these next few years, I think my portfolio is going to end up looking a lot more simplified and streamlined than it does now. Not that it's bad. Like I only have about 20 holdings, so I think it's good. But I think over time, my portfolio will, well, hopefully this is the goal, right? It'll just keep getting better and better with holdings I understand better and feel better about, and hopefully will generate better returns than the first few picks. But there's some staples in my portfolio that I never plan to get rid of. And once again, never say never, but don't intend to get rid of ones that I plan to hold for a long time and keep adding to. Johnson & Johnson, Procter & Gamble, Starbucks, Williams-Sonoma potentially. We'll see what happens with the share price. At some point, I might just have to bite the bullet and start stacking up some more shares because I really do like that company. Snap-on's another one of those. But then there's some others that I like having, but also I don't feel would be as strong as some of my other holdings. You guys feel that way too? Like I feel that I have a pretty solid batch of holdings, but I'm also not immune to the idea that some are stronger than others, But what I want to do, over time, what I want to do is not have that be the case too much in my portfolio. I want to pick. I don't know. I'm gonna keep rambling on the subject. Let's keep going. Sorry, guys. Anthony says 33% SCHD, 32% VU. Wow, this is crazy. SHD is my largest. My goal is 7,000 shares and not too far from it. That's incredible. Great. Dorte, my largest dividend or position is OCSL. What is that? What is OCSL? It is my biggest dividend payment, even paid a special dividend of 7 cents here in December. OCSL. Whoa. Hello. Excuse me, guys. Oak Tree Specialty Lending. Huh. Interesting. Okay, let's keep going. Let's see. This is nice. New to the channel, love watching your videos. Thank you for being here. Thank you for being here. I'm really happy to hear that. Thank you for all the support. And yeah, thanks for tuning in and leaving that comment. I appreciate that. Let's see. This is a good question too. Is it stupid to keep investing in JEPI? Yeah, I don't know that it's stupid. I think it just kind of depends on you and your situation. For me, I mean, JEPI is Jeppy's been fine. I actually really don't have any serious qualms with Jeppy, but I'm just kind of getting to the point. Um, I'm just kind of getting to the point with it where, I'd rather have that money invested in an actual company that's producing some sort of like, I don't know, goods and services or products or whatever, and have it more in something like that than a covered call ETF. I think at the stage of the game that I'm at right now, and just based on my interests and what I like to spend my time researching, I think for me that makes more sense. But for someone who's strictly looking for cash flow and doesn't mind that it might fluctuate on a monthly basis in either direction, I don't think Jeppy's too bad of a way to go. I think it's been a fine fund so far. I often forget how new it is too. It's only been around since 2020, which I guess as it pertains to a lot of the covered call ETFs, it is a little bit older than some of the other ones. But I'll be interested to see how, what Jeppy looks like in the coming years, and if it, how the payments trend over time. But I don't know. I don't think Jeppy's all evil or anything like that. I think it just kind of depends on what you're looking for out of a particular security. So let's keep going here. El Dynamico says, for the time being, my biggest position is Altria Group. Okay, there we go. Let's see. Jay here, good batch of holdings. SEHD, Kroger, and Williams Sonoma. Very nice. And I love it, guys. We have 217 people in the stream right now. That's incredible. Thank you all for tuning in. I really do appreciate it. I'm so happy to have you guys spending your Friday night or this hour on your Friday night with me. I hope you're enjoying it as well. Oh, and I do have an announcement that I'll share in just a moment. Let me pull it up on the screen so I don't forget. Oops, one sec. I'll come to it in a second. So let's keep going. Thomas largest is VGT. Yeah. Ooh, Visa. Good stuff. Let's see. This is funny. SHD is like my firstborn. That's awesome. Mountain High says EPD is my largest position. Nice. I really do like EPD a lot. It is honestly, I'd say EPD is one of my more favorite companies. I would not even at its price. I think right now I'm up somewhere over 20%, maybe between 15 and 20% actually on a share price. Just talking about share price, I would not mind adding some more to it, and using like if I sold Jeppy or sold AT&T and Verizon, would not mind rolling some of that into Enterprise Products Partners. Let's see. Journeyman number 1 is Kenvue. Interesting. Number 2 is JP Morgan. Okay. Nice. Let's see. Let's keep going here. Chris, yeah, Walmart's his biggest position. He's got a pretty killer Walmart position, guys. I'll tell you what. We'll go through a couple more here. Mark says EOG and Altria. Tim says, wow, 175 shares of Realty Income. Nice. Australia's best blood sausage. Visa is 22% of my portfolio. I'll not sell for a very long time. Nice. Let's keep going. Yeah, Mount High. I bought into Snap-on at 211. I can't pull the trigger to buy more. I know. I'm with you, man. I really want to buy more because I love that company. But yeah, it's been a good performer. I mean, it's that's just like the double-edged sword, right? You want your stocks to do well, but like not too well that they go out of buying range, I guess. Yeah, this is funny. I think this chat owns all the SCHD shares. I think you're right. There's worse things we could buy into for sure. Let's see. This is an interesting question. I think it's split up into 2 comments here. So, knowing that over 10 plus year time period, there's probably a 99% chance we cannot beat the market with individual stock picking. In addition to the fact the S&P has about a 1.5% yield with about an 8 to 10% dividend growth rate, how do we make the case we are not going the wrong route, which will cost us dearly in the end? Is our ego and pride getting in the way? Man, this is a really good question, and I want you guys to share your thoughts on this in the chat as well, because I'm sure you guys have some thoughts. But let me try and simplify the question a little bit, just for myself, honestly. So over a long period of time, knowing that you likely will not beat the market, essentially, are you kidding yourself to even try? Like, wouldn't you be best off just investing in the S&P 500? Perhaps, I obviously, even most professional fund managers, even most professional money managers don't beat the S&P 500. So, yeah, it does beg the question, if those are the stats, then what's the point of even investing in individual stocks? And you may not beat the market. You may, there's certainly the possibility. We never know what the future is going to hold. We don't know what things are going to look like. So there's a possibility. Um, but outside of that, two things come to mind. Number one, for a lot of people who pick individual stocks, the reason they do so, I mean, in addition to trying their hand at beating the market or whatever, um, a lot of people do it just because it's fun. It doesn't have at least I can't speak for everyone, obviously, but in some cases, it doesn't have to. It's not so much about ego and pride and whatnot. It's more so about just really enjoying the process of researching companies and custom building your portfolio to, I guess, see if you were right. Just see, kind of see what happens, and to I guess have a little bit more control over what your money goes into. And I think for some people, that's worth the chance of having returns that deviate from the rest of the market. And once again, that deviation could either be for the positive or it could be for the negative. It just depends on a lot of factors, obviously. So I think for a lot of people, it's kind of a fun thing and it's kind of a hobby. I'm speaking personally when I say that. It's fun for me. I can't tell you, it's been such a good learning experience picking individual companies. Um, I've learned a lot from the bad decisions as well as the good ones. But in general, it's been a huge learning experience. So I'm very grateful to have been able to try my hand at doing this and to be better at it, maybe today than I was a few years ago. And I think that there's application outside of investing that I've learned from researching and picking individual stocks, and learning about individual companies. I think there's a lot of takeaways that you can apply elsewhere. So I think there's that aspect to it. But especially for dividend investors, and some are going to disagree with me on this, but I also think there's more than one way to measure success. In as it pertains specifically to dividend investing. Um, a lot of us get into this not so much with the goal to beat the market. I mean, that'd be nice if it happens, but a lot of us are just trying to create some passive income. A lot of us are just trying to quit our jobs. And whether or not, in theory, I guess you don't, in reality, you wouldn't want to maybe do it this way, but in theory, if your goal is just that, to someday retire and live off your passive income, in theory, you could beat the market 0 years out of infinity and still reach that goal. As long as your passive income is sustainably able to cover your expenses, then that's really what a lot of investors, at least a lot of the investors that I think watch this channel, are really going after. And so obviously you don't want to underperform the market, like, I guess, a whole lot or whatever, or and that's also not to say that you should just go for the highest yield possible because it's all about the income, because that's not necessarily the case. There's got to be some balance there. But I do think that there is more than one way to measure success, um, other than just beating the market. Like, for another example of this, I always make these type of comparisons. But if you're into lifting weights or getting into lifting weights, not everyone who goes and bench presses wants to be Mr. Olympia. Some people just want to get in shape and lose a little bit of weight and put on a little bit of muscle. And you don't have to. I don't know. Maybe that's not the best comparison, but that's kind of how I think about it. And hopefully that makes sense. I think that was a really good question. And once again, too, you guys in the live chat, I'd love to hear your thoughts on this. So let's keep going. Yeah, I want to see what you guys have to say about it. And I'm sorry if I'm skipping over some of your guys' comments. Let's see. Anthony says, I look at investing like a risky bank account. Keep adding and adding whether the market is up and down. Okay. El Dynamico, I think emotions play a big part regardless of how unchecked you have them. Yeah, I try to keep my emotions in check, even though sometimes it's pretty hard. So Hans says, I think Warren Buffett said 97% of professional investors don't beat the market. I don't even know if that was Warren. That's just kind of like a pretty common stat. I mean, I'm sure he's talked about that, um, but yeah. Yeah, quit job, achievement unlocked. And once again, that's not to say because a lot of people might take that idea and be like, okay, well, if that's all I need to do, let me just get there as fast as possible and buy the highest yielding security so I can quit my job and raise my passive income even faster. That's also not a good approach. Once again, there's got to be balance with this stuff, you know? Um, it's important, I think, to own things that have share price returns, but also can pay you some cash flow and that have that cash flow grow over a period of years. There's no shortcut to this. There's no fast track to financial freedom. You know, some people will say, well, just buy Bitcoin, you'll get there faster. I guess it depends. As of late, that's certainly been true. There's no denying that. But you know, anything worth having for a lot of us, financial freedom is that thing worth having that we're all shooting for. You know, that's not something that's going to come easy. It's not something that's going to come overnight. And like I said, for a lot of us, that's the goal, that's the trophy. And it's not as much about beating the market. So Andy says, okay, to beat the market, you need to understand that the market is not the benchmark. Buy the market, aka VOO, then fees, dollar cost average come into play. Yeah, and yeah, right here too. I think if you're having fun with the process, you're more likely to invest more. Yeah, I personally think it's just been such a, and I'm sure you guys have experienced this too. It's just been such a big learning experience, learning about all this stuff. It teaches you about accounting, and it teaches you about how, in some ways, it teaches you about how the world works, and it teaches you about a little bit about human psychology and how people interact with these products and services, and maybe why that is. And you use that information to try and predict what might happen next. And you might be right, and you might be wrong. And it's just a combination of all those really complex things coming together. And you know, in that chaos of thinking about all those things, that's kind of where the fun is. Interestingly enough, you know, it's not fun for everyone. Obviously, it might not be for you, which is fine. But I guess all that's to say is everyone does things differently, and you've got to find the way that works for you and gets you to stick with it. And if that's just the S&P and you want it out of sight and out of mind, or if it's just in ETFs, fantastic. But you know, if you kind of get going down this road and you want to sink your teeth in and learn a little bit more, well, why not? Once again, I think that there's been some takeaways from doing this and learning about this that are applicable elsewhere. And that's the thing, you know, and I'm sorry to go on a tangent, but I really like this question. This is a really good question. It really has me thinking. Why, you know, when you think about it, why do we look up to people like Warren and Charlie so much? Yeah, obviously they've been very successful in the market, but one of the things, at least I think, one of the things, one of the bigger reasons, probably even more so, the reason that we look up to them so much is just because they're so wise, they're so sage, and so full of good advice and life experience and life lessons. Um, but you know, a lot of that came from just thinking about these businesses, and a lot of that came from being investors. And there was one point where Charlie said something to the extent of investing is a subset of worldly wisdom. And that's cool, you know, to and that's why he preached reading so much and whatnot, and was so big on every day trying to learn something new and become more wise and get 1% better. It's just, you know, I guess what I'm trying to say, or the point I'm trying to arrive at, is there's a little bit of personal development. There's an aspect of personal development that comes with studying this stuff. So, you know, that's another reason why I personally like doing this. So anyway, let's keep going here. Once again, I'm sorry to go on that tangent, but yeah, really good question. I like talking about that stuff. So, um, oh, this is a really good question too. So Kevin says, question my brother Ryan. All right, man. How do you feel about having emergency funds in the bank, or should we always keep our money working the market? I personally am a big. I think everyone would agree with this too. You got to have some rainy day money. You got to have some just in case money, just because it's a crazy world out there. It's becoming increasingly crazy. Things can, you know, an anvil can drop out of the sky, or a piano can drop out of the sky and crush you on any given Sunday. But you got to have some money aside for emergencies, just in case the unthinkable and the unforeseen happens, because that's it always does. Things happen when you least expect it, and you want to be prepared. So I personally, especially just with the nature of this job of making these videos and writing the newsletter full time, um, there's a lot of fluctuations, and there can be a lot of uncertainty. So me personally, I probably keep more cash than the normal individual, just to be prepared for other things. So yeah, I think it's really a prudent thing to keep some cash on the side. And fortunately, right now, if you have some cash and are concerned about missing out on gains or interest or anything like that, you could put it in a high yield savings account right now and make a pretty good return on that. So um, I guess that's the silver lining to having interest rates where they're at right now. Let's see. Really good question though. Thank you for asking that. Um, Wes here says thoughts on the Google controversy. I'm not sure what it is, what the Google controversy is. Yeah, I don't know. Let me know what it is. I haven't really been keeping tabs on it. Let's see here. Yeah, so Nate here says, "Poor Starbucks, another falls to politics. When will they learn?" I'm guessing you're talking about. I could be wrong, but I'm guessing you're talking about the union stuff. I know that there's been this either has happened or is happening. The board of Starbucks is going to be adding a few representatives from the labor union. I need to read a little bit more into that, but I read something about that happening. Is that what you're talking about? And I'm curious to know too your guys' thoughts on Starbucks right now and the union stuff and the future of the company. Those of you who keep tabs on it, what do you think about that? What do you think about Starbucks 5 years from now, 10 years from now, and stuff like that? Let's see. Let's keep going. Uh, oh, this is a great question. Any thoughts on McDonald's new concept restaurant called Cosmix? COSMCS. I'll show you guys it. I actually, you know, I've only seen the Cosmix. Okay, let me go back to the screen real quick. Bear with me. So this is what it looks like. Oops, hide this. I think this looks pretty cool. The menu, from what I read, it's going to be coffee stuff, and I think that they're planning on doing some custom drinks similar to how Starbucks does. You know how you can get your syrups, you can pretty much custom build your drink however you want. We'll see what happens with it. I guess that's all I can really say. Let's see what happens with it. I read a little bit on it, and I think a lot of the franchisees were a bit confused on the whole thing. Like they felt that they need more information about what's going on and don't feel super confident about the project so far. But we'll see what happens with it. Okay, so Google faked their Genesis AI demo release. Okay, I haven't seen that yet. I actually saw Joseph Carlson posted a video yesterday or 2 days ago about Google's AI thing, and then today he posted one with the thumbnail. Is it fake or was it faked or something like that? That's all I've seen about it. I have not read into it, so I can't really speak on it that well. Nathan here says, "What do you think about WP Carey and their dividend cut?" This is a great question. Thank you for asking. So it's obviously not ideal. Like anytime you get less in dividends, it's not it's not very nice. Um, but I'm trying to be objective about it, and I'm trying to be objective about it, and as it pertains to the cut, about 20% reduction. Once again, not ideal, but at the same time, I feel okay continuing to hold and add more because I personally feel that the reduction didn't come as a result of poor financial performance. They're just losing out on, rental income by not having those properties in their portfolio anymore. And whether or not it was the right move to spin off the office properties in general is a whole different conversation. There's mixed thoughts on that. I feel fine about it. The way that they went about it, undeniably could have been better. So I think that's where WP Carey went wrong. But the move as a whole, I'm fine with. From a long-term perspective, I feel fine with it. And once again, I'll say it a third time. It's not ideal to have, as a shareholder, it's not ideal to be making less dividend income. But it also brings me solace to know that the cut was not as a result, did not come as a result of just them having poor finances. If they wouldn't have spun off the office properties, the dividend would still be intact. Now we can compare that to Realty Income, who also spun off their office properties a couple years ago, last year, a couple years ago. Well, they didn't spin off their office, or they didn't reduce their dividend. So, there's that aspect to it as well. But overall, I feel fine with it. Once again, I want to try and be objective about it, not just sell only because they cut the dividend. I think that there's a bit more nuance to the conversation than that. And I don't blame anyone for selling out of their position or being upset with WP Carey, because like I said, undeniably the conversation around, or the communication around doing it, could have been much better. So, and rightfully, it seems that they've lost some trust with some current or former shareholders now, and rightfully so. But prior to that, I'll say, like, WP Carey was a shining star in the real estate investment trust. I don't know. I don't want to call it a community, but it's consistently been held in high regard. So hopefully that answers your question. I know I was kind of saying a lot of going in a few different directions there, but overall, obviously, I'm still holding on to WP Carey. I just bought some more last week. The cut's not surprising. We knew it was going to be happening for at least a month or a couple months now, and now it's just finally coming to. So let's see. Let's keep going here. Okay, yeah, Joseph Carlson. Yeah, I like Joseph Carlson a lot. I really enjoy watching his videos. Let's see. Interestingly enough, I'm all caught up in the chat. So, and we have just a few minutes left in the stream, but I want to show you guys. I said a few minutes ago, I actually did forget about it, even though it's pulled up right here on the computer. I do have an announcement for you. It's not anything too crazy, but I'll go over here. So for those of you who are on Instagram, I just started a new Instagram page. I'm going to start posting some more finance stuff over there. I'll try and share some daily portfolio updates, just definitely share some stuff over here in the stories, and be a bit more active over there on a day-to-day basis. I'll also be posting some short form content as well, and maybe we'll be expanding that over time. But I'd love it if you guys could shoot me a follow on Instagram if you're over there, if you use the platform at all. The handle is Retire with Ryan. And I do have another Instagram account that's just my name, Ryan Williams, but that's just my personal Instagram. I certainly don't use that to post about stock stuff. But in general, I don't really post over there that much as it is. So I could see myself posting a lot more over here, both on the feed and in the stories. So, and maybe even more from there. We'll see what happens. But I'd love it if you guys shot me a follow over there, shoot me a DM on Instagram, stay in touch with me there. Like I said, on a day-to-day basis, I'm going to try and post some more stuff over there as well. So let's see. That's about all I got for you guys. We got a couple minutes left in the stream. Do you guys have any last minute questions for me? We still got 211 people in the stream tonight. Really active stream. So let me know. You guys have any other questions? Anything else we need to talk about tonight? So Sir Dudebar Man just followed. Love it. Thank you so much. Blaze twisted off a bottle of Tanqueray. Good job, man. That's great. Let's roll through a review of SHW. I like it. Great idea, man. So let's go over to the screen here. We'll jump over to Seeking Alpha. Okay. SHW. Let's check it out. Check it out. Okay. So who sings it, guys? It's actually check it out. Who sings it though? You guys know it. Okay. So looking at Sherwin-Williams. Pretty solid share price performance, right? Year to date, they're up 21%. I think that's pretty right in line with the S&P 500. I think the S&P's up about 20% this year. Currently sitting at the top of their 52-week range. Okay, PE ratio looking at about 28.25. Okay, we got that low yield. We'll take a look at the dividend stats momentarily, but let's jump over to the valuation real quick. Wow. So the PE ratio is about almost 40% higher than the 5-year average PE ratio. Also, I see you guys' Beastie Boys comments there in the live chat. You know it. You know it. Scrolling down, price to book. Wow. And this is, excuse me, this isn't a deal breaker or anything, but 20.21 for the price to book. 45% higher than the 5-year average. Price to cash flow is 27.5% above the 5-year average. So by just the relative valuation metrics compared to itself across, the last 5 years on average, it's trading a bit more expensively. We'll look at the dividend stats real quick. So we already saw on the homepage there, really low starting yield, 0.8%. This isn't, once again, though, it's not really a deal breaker. If you've got a long time horizon, especially with this dividend growth rate, across 15, 20, 25 years, and I think we can assume, or just for the sake of being conservative, that this will not be the case over that time period. Let's just assume it ends up being lower. But man, even if it was 10%, even if it was 9%, that's still a pretty respectable 5-year dividend growth rate. So saying this at 16% is great. Nice low payout ratio, 45 years of dividend growth. And I think there's a lot to like about these dividend stats. And actually, let's go over to I think it's dividend growth, perhaps. It's either dividend growth or dividend yield. Wow. Oh, that's the CAGR, excuse me. Is it CAGR or CAGR? What do you guys say? What do you guys say? This is what I wanted. So the 5-year yield on cost. After 5 years, if you just held at the current growth rate, it's still, not anything crazy to write home about. 1.86% would be your yield on cost after 5 years, but still that's over, your yield on cost from the time of purchasing would have more than doubled only in 5 years. So imagine another 5 years goes by and another 5 years after that. You have to look as best as you can into the future, as far out as you can. And here we go. So if we can, let's see how much we can zoom out here. So, wow, holy cow. Okay. So let's see here. What is this? Oh, wow. Okay, so this is going way back. So what this chart here does, and I don't know if you guys have ever used this, for those of you who use Seeking Alpha Premium, which if you want to check that out, try a 7-day trial. There's a link to Seeking Alpha Premium in the description. So what this chart shows us, if you picked up some Sherwin-Williams on any of these given days, you can see the purchased, that's the date right there. So if you purchased it on that date, that's what your yield on cost would be today. So let's just go back 10 years, okay? So let's go back, we can do that right here. So if you would have bought it 10 years ago on, December 9th, 2013, your yield on cost would be 4%. That's not too bad. And you know what, guys? 10 years sounds like a lot of time, but in the grand scheme of things, across the duration of your life, even if let's say you started investing when you're in your 50s, yeah, chances are you've got at least another good 25, 30. Obviously, everyone's different. I'm making a lot of generalizations. You still got another good 30, 35 years of compounding left in you, right? But for those of us younger guys and gals out here, I'm only 30. 10 years is not a long time. But let's zoom out even more. Let's go back 20 years. So if you would have bought Sherwin-Williams 20 years ago, okay, so let's go to where's December 2003? I'm keep passing it. Okay, let's just go right here. So if you would have purchased 20 years ago, your yield on cost with Sherwin-Williams today would be about 21.5%. That's unreal. And still, 20 years is not, you still got a lot of compounding left in you after 20 years. Let's just, for fun, let's go back 30 years and we'll switch gears, look at the financials a little bit. So 30 years ago, your yield on cost would be closer to 50% with Sherwin-Williams. That's just the power of time, guys. And that's why they say time in the market beats timing the market. Pretty unbelievable. But let's go look at the finances real quick. See, we can scroll, just take a quick scroll, see what's happening. So, a lot of growth here on the top line, right? So pretty consistent growth over time, at least over these last 10 years. Revenues more than doubled. Gross profit is also more than doubled. Let's see how it's held up as a percent of revenue. It's pretty steady, 45%, like pretty much identical actually over this 10-year period. Continuing to scroll down, after you account for their operating expenses, what's left over, they've actually increased their profitability. So the more that we go down the income statement, and there's some once again, I may be generalizing a little bit because it jumps from 11 to 14 pretty quick, but it tends to hover between about 11% and now, 15% here on the high end. So I think it's on average probably increasing just a little bit. So let's keep going here. Now, let's keep going. Where are we? Let's look at the net income margin here. So this is once again getting better over time as well, going from 7.4%, 7.8%, up to 9, then 11, then down to 6 and 8. But I'd say more often than not, we're looking at an increase in net income as a percentage of revenue. So that's trending in a good direction, it looks like. Earnings per share and revenue per share look pretty sweet. They're buying back shares over the last 10 years, nothing too crazy. Going from, well, I guess that is pretty nice actually. Over 10% of their shares, almost 20% of their shares, maybe 15 to 20% of their shares bought back just in the last 10 years. Going from 302 million shares outstanding to 256 million. Pretty nice. We saw the dividend stats already, really nice dividend growth. The payout ratio has historically been very low, very steady. So the income statement's looking good. We'll take a quick look at the balance sheet. And I really just want to look at, let's change this. I really just want to look at the debt real quick. And if I'm taking a quick scan, guys, if I'm just kind of like in this instance here, if I just want a quick look, I'll just look at the debt. 11.3 billion on a net basis, 11.8 total debt. How much of that is, I do want to see how much of that is short-term and how much of that is long-term. Goodwill really went up. Wow. So they must have made some acquisitions. Let's see. Long-term debt. So most of it's long-term. How many short-term borrowings? Oh, this does current portion of debt. That is kind of a lot, actually. 1.1 billion of their long-term debt is coming due this year. So, and they have another 340 million of short-term debt, of current debt due within the next year on top of that. So, okay. So once again, guys, looking at the debt, so do 11.3 billion. Let's look at the cash flow real quick. And how much cash do they have on hand, actually? So only 500 million of cash. Okay. I shouldn't say only 500 million, but okay. So 500 million of cash. And okay, this is okay. 2.3 billion. 2.3 billion in levered free cash flow. This is a good free cash flow year for them there. Though prior to that, we're looking at 1.2, 1.4, 1.3. So we could probably guesstimate somewhere between 1.4 and maybe 1.8 billion dollars of free cash flow on average over these last 10 years. And based on that, I mean, the debt seems serviceable, right? Like if they just put all their free cash flow towards the debt, just based on the trailing 12 months, they'll pay that off in a few years, but we can't necessarily assume that 2 billion of free cash flow was a little bit on the higher end. So, but it's not anything too crazy, nothing to get too worked up about at this point, in my opinion. They can at least pay down their short-term borrowings, pay off this current portion of their long-term debt. So overall, I think Sherwin-Williams, and once again, guys, very quick scan. And truth be told, there's still so much I have to learn about these three financial statements. I'm getting better. This has been like, for me, this has been the biggest learning curve so far. But overall, from what I can see here, it looks pretty decent. Very quick scan once again. I do want to see the growth. If we go over to the growth page, though, looking at how their sales and their net income, stuff like that's trending over the years. So zooming out over the last 10 years, revenue's grown by a compound annual rate of almost 9%. Very nice. Net income is growing even faster than the revenue. So like we kind of talked about a moment ago, over time, they're becoming more profitable on the bottom line. The bottom line's expanding more than the top line is. So I think that's good to see. Free cash flow's growing at a rate that's faster than revenue as well. So over time, it does appear that Sherwin-Williams is becoming more profitable, which is great. That's really fantastic. And the financial statements look pretty good as it is. So, yeah. And, I didn't really mention this either, but a 45% gross profit margin, that's not too bad. It's really not too bad. So I dig it. I think Sherwin-Williams is a pretty good looking company. At least just from what we've seen here. Obviously, there's still so much to consider with it. But Yeah, I don't know. One thing just off the top of my head, one thing that I am kind of I do feel like I'm seeing is, um, and they're going to have really strong brand recognition, right? Like when you think paint, Sherwin-Williams is one of the first brands that comes to mind. Them, Bear, those are the first two that are top of mind for me right now. But I see companies like Home Depot and Lowe's now coming out with their own brand of paint, and probably will want to push those more in store than some of the other brands like Bear or Williams Sonoma. And not sure how much of an impact that's going to have on companies like Sherwin Williams, but that is one of the risks. And obviously, some other risks are going to be stuff that's happening in the home building industry and just the real estate industry in general. So, um, and I'm sorry, I saw the super chat from a couple minutes ago. Thank you so much, by the way. We'll wrap it up here in just a moment too. How do you feel about Microsoft? They've been around a while, but seem to stay in the game now, going in on AI. Yeah, I mean, I have a hard time saying anything bad about Microsoft. To be honest with you, I first and foremost, like it is a beast of a company, but also it's not one that I've spent too much time on. And I'm familiar with what they do. I'm pretty familiar with what they do, but I also think just because they do so much, there's a lot that I still have to uncover about Microsoft. But in general, it's a beast of a company, really solid growth. I don't even think they have any debt. Let me double check that. But really solid growth in the company. Let's just, real very quickly, very, very quickly. So look at that growth. Like, definitely over a 50% gross profit margin too. Like that's pretty crazy. And it's been pretty steady, about 70%. Operating margins going up over time. Their net income margin has increased by about 10% over the last decade. And once again, like I said, I don't believe they have any debt. So just strictly from a financial standpoint, Microsoft's pretty dang solid. Yeah. So I mean, they have debt, but they have more cash and short-term investments that they can pay off all their debt today if they wanted to, and they'd still have like $40 billion left over when it's all said and done. So I don't think you can go wrong with Microsoft. I really don't. Um, oh, thank you. Great live chat today, Ryan, and awesome to look at everyone's comments. Loving it. This is a very awesome community to be part of. I agree. This is one of the best communities on the internet. The dividend investing community, is a really supportive bunch, and everyone wants everyone else to win, and that's what I really love about it. And it's just been so cool. I feel like over these last few years that I've been doing this and making videos on it, I've really seen this community grow and see it continue to grow. Not just dividend investing in particular, but investing in general. It's really cool to see more and more people taking an interest in this. And it's been very cool to see a lot of younger people taking an interest in this. I tell you guys what, I have a funny story for you guys too, before we wrap it up. And I know I said we got to go, but something in this sparkling ice, I guess. But yeah, there's a lot of channels popping up of like, kids not even 18 years old yet, sharing their portfolios, sharing their investing journeys and stuff like that. And I think it's great. It's been really, really cool to see. But anyway, I have a really funny story for you guys. So yesterday morning, and he might even be watching. Charles, if you're watching, what's up, man? So yesterday morning, I get this text out of nowhere, and it's from a number with an area code from my hometown that I didn't have saved. And the text was basically like, "Hey, man, I don't know if this is still the same number, but this is, this is his name's Charles. This is Charles, and I just was on YouTube, and I haven't talked to this friend of mine, guys. This is a guy that I went all through school with since 5th grade, and so I've known him probably 20 years, but I haven't talked to him probably for a decade or so. But anyway, he texted me out of the blue. Hey, I'm on YouTube. I hope this is still the same number. But I'm on YouTube and I thought I saw a familiar face, and lo and behold, it's your videos. I didn't even know you did this. It's super cool. And so I was like, that's awesome. Like we haven't talked in a long time. But I asked him, like, how did you even find the video? What did it just pop up on your homepage or something? He's like, yeah, I follow a couple other finance channels, and yours was a video that was recommended to me. And yeah, it was just a really, I don't know, one of those like small world kind of things. But I thought it was very cool, and it was it was good to know that I finally like know someone in my real life that's interested in this stuff. I finally have a real friend who, you know, aside from all you guys, like someone that I actually physically know who's into investing. So it was very cool. And it was also very good to hear from him. He was always a good guy. But anyway, I just thought you guys would get a kick out of that story. But let's see. Yeah, I know. Here it is. I'm so consumed with answering questions that I can't go. Having fun tonight. No, guys, but we got to wrap it up. I got some turkey burgers waiting for me, and if you guys know anything about me, I am powerless before turkey burgers. Love me some burgers. But yeah, there we go, Michael. Can you start over? You were in diapers 20 years ago. No, I was 10 years old, so I'd been out of diapers for a year. Get it? But yeah, so I'm 30 now. But anyway, guys, we're gonna wrap it up here. Really fun stream tonight. You know, and the more that I do these, the more that and you guys probably have gathered this already, but the more that I do these, the more that I realize what really makes the difference between a stream like this, where when we're wrapping it up, we look back and say, man, that was, or even, you know, after the camera stops, I'll say like, man, that was a really good stream tonight. What makes a difference every single time is the chat. So thank you guys for all being so active. Thank you for hanging out. And just thanks for being here tonight, because it really does make a difference. It makes the difference. So keep at it. Hope to see all of you guys, all 158 of you, back here, same time, same place, next Friday night for the 77th Dividend Happy Hour. Now, before we wrap it up, couple just reminders. Remember, number one, just go shoot me a follow on Instagram. I'd love to hear from you guys. At Retire with Ryan. I'm going to do my best to start posting over there. I'll definitely be posting videos. I'll try to be really good about being on the story over there as well. Number two, I should have mentioned this earlier, but I have a really important video coming out on Sunday. This is one, really important video. It's one that I think you guys will enjoy. The topic has to do with something that you guys have actually been hounding me by. Excuse me, guys. The topic has to do with something that a lot of you guys have been on my case about for quite a long time. So I think you guys will feel justice from it. And yeah, anyway, long story short, I think it's a really important video. It was a really important video, and I really hope you guys check it out and leave me a comment too on the video and let me know your thoughts, because this one, once again, it's like one of the more important videos I think I've made in a while. Has to do with something in my portfolio, just kind of thoughts on the portfolio moving forward and making a big change to the portfolio. So yeah, what is the stock? Oh, it was Johnson & Johnson. But anyway, that's it, guys. I just wanted Instagram and video on Sunday. And number three, I hope you guys have a great weekend. Thank you once again so much for tuning in. You guys keep up the good work, keep climbing, keep stacking that cash, keep creating that cash flow, and just keep doing your thing. You guys are doing great. So have a good weekend, guys, and I will see you on Sunday, and also see you Monday for Walk to 100. So be there.